people get online, they round things up, they round things down, they leave things out. And the last thing you want to do is for me to issue a pre-approval letter based on just an online application. And then you take your buyers out, they go find the house they love, and oh, sorry, that information they put online wasn't correct and they don't qualify for that house, right? So that's one thing that is really important. The two main things that we focus on are communication, and then making sure that our clients have a really personal touch. So as you can see, we like to do really fun things. We send our clients crumble cookies in the middle of the process. I go to all of my closings. I bring a really nice gift. I bring them a folder with their appraisal and credit report. And I actually, the reason I got invited to present for you guys, Lynn was on the other side of a transaction. So she was the listing agent. And I make it a point to make sure that I communicate with everyone in the transaction, the listing agent, the buyer's agent, and the buyers. So the deal I did with Lynn, actually, we closed in 8 days from acceptance to recording. So we're really fast, we're really efficient. Like I said, I've been doing this for a long time, so we've got our system pretty well down. So do you want to switch to the sheet? So I'm going to bring up this is kind of an interactive, and Jeff and Lynn will send this out to you guys. But so right now, when you're talking with buyers, what's their hesitancy with buying right now?
Interest rates,
right? So, and I have clients saying, they call me to fill out an application and they're like, oh, I just do not want to buy. I think I'm going to wait until interest rates go down, right? That's what everyone says. So what happens when interest rates go down? Prices go up, right? So, I'm sure you've had this conversation of, if you wait, you're going to find yourself in a market like we were a year ago, right? So first time home buyers, people with little money down, those buyers couldn't even compete. And also there was not very much inventory, right? So people were kind of forced to buy houses that maybe they otherwise would not have bought because there just wasn't a lot out there.
Well, let me hit escape. It's probably we just have to click over there. Or are we going small? Like on the screen? Yeah. Oh, there we go. You're good. I'll do it. There we go. There we go.
So this is just kind of a side-by-side comparison that you can use when you're meeting with your buyers. All of the boxes that have a border around them, you can actually modify those. So this is actually a really conservative example, but so in March of 22, the market's crazy, and you have a house that was listed for $1 million. There probably would have been conservatively 8 to 12 offers on a house like that. And so, most buyers were asking over list price. So in this example, we did $1,075,000. So 75 over list with a 20% down payment. So 20% down would have been $215,000 out of pocket. And their loan amount would have been $860,000. So interest rates back then were probably on average about 3.875, which would have been that principal and interest payment. And then if you compare that same property today, and again, these are really conservative numbers, but rather than that same house being listed $1 million, it would be listed at $900,000 today. Most of the time, most buyers are going in under list, I would say, with their offer. So in this example, $25,000 under list price. So instead of paying $1,075,000 for this house, they're paying $875,000. So their down payment is $175,000. So much less out of pocket. And because of the difference in the price, you can see that although the interest rate is almost double, 6.875 in this example, the payment's only $554 higher, which is not that much on $1 million house, right? But the bigger thing is less cash out of pocket. And, in today's market, we're seeing seller concessions, which we would have never seen a year ago, right? So we're using those concessions for buy downs. I'm sure you've heard that 3-2-1 buy downs, 2-1 buy downs, 1-0 buy downs. So you can also get that rate lower than 6.875, but this is kind of a par interest rate. So total out-of-pocket savings is 72,000. So assuming that they can refinance prior to 10.82 years, it's better to buy this house today at 6.875 than it would have been to buy it at 3.875. So they can send you this, you can kind of walk through this, but it's interesting that you would think that buyers would kind of understand that concept, knowing, because people were pretty aware of what the market looked like. And some of the buyers in today's market were trying to buy back then and they just kind of bailed, right? But they don't really understand what that looks like, what the difference in price, because people are so worried about the interest rate. So if you can kind of take a step back from just the rate and show them the numbers. And, you know, someone that paid $1 million for this house, they don't get to go back next year when rates go down and say, hey, you know what, I actually didn't really want to pay that. So is there any way I could get 100 grand back? I overpaid, but they can refinance, right? So they can refinance in a year or 2 years, whenever it is that interest rates go down. So this is just kind of a tool that you can use to show your buyers that it's a really good time to buy right now. Any questions about that? Nope.
None in the chat right now, but talk a little bit more about that opportunity for your buyers. Like literally, because I think we were kind of talking on Monday that buyers might be super scared to buy right now. So can you give any talking points that would be super simple talking points on what you might be able to answer that would help them understand without having to bring out a spreadsheet?
Well, I mean, I think just the fact that, like I said, the down payment is a huge one. So cash out of pocket, much less. The inventory is a big one. So I heard a statistic the other day that 40% of people that bought over the last 2 years when the market was crazy actually have remorse about the property that they bought. Because people that had to buy were forced to, well, there's 2 properties that fit in my kid's school district, or, you know, or in a certain county. I mean, there just weren't a lot of houses. So now you actually have a lot to choose from. And then, like I said, the fact that you can refinance when rates go down. So, and the seller concessions are huge too. So that's something that I just got a seller concession from a builder, and I was not the preferred lender, and they gave a $43,000 concession that I bought the rate down, and I did a 2-1 buy down. So their rate is starting at 4.25. So don't be afraid to ask for those concessions, because we're seeing a ton of them and large amounts of concessions.
What would you say is the biggest, like, for like an average home out there, 500,000, 600,000? What kind of concessions are you seeing?
I just did a
Average.
VA deal that was 25,000 in concessions. So I would say probably 15-ish thousand for that. I mean, 3% easy.
Yeah, that's nice.
Yeah.
That's way nice.
So I mean, if rate is their thing, you know, a 2-1 buy down is a really great option, because it gives them that 2-year period of time where it kind of gradually steps up, that payment goes up. And if they refinance, they actually get whatever portion of that by the concession back that we can use to refinance them and pay their closing costs. It doesn't just go away like a traditional buy down does. So any other questions about that? No?
This spreadsheet, I may have blanked out for the, but did you say you have a link to it?
Yeah, so I sent it to
Yeah,
Jeff, and they have it, and they'll
I'll
send it out to you.
Sure.
And then, like I said, you can just modify any of those. If you're sitting down with your buyer, you can
Yeah.
pull up a listing,
All of that.
you know, that's similar, or maybe the same house was listed. And do kind of that side-by-side comparison, and whether you're talking to them in person or you're over Zoom, you can kind of have that conversation. And sometimes people that are visual, it's easier to see it in something like this, and all of those numbers will update for you.
That's awesome.
Perfect.
Yeah.
Okay, all right, so we're gonna play a little game. So I'm sure all of you guys remember the show, Are You Smarter Than a Fifth Grader? So today we're going to play Are You Smarter Than a Mortgage Lender? Is what we're playing today. So the way this is gonna work is I'm going to read a question. You have to raise your hand, so don't just blurt out the answer. Jamie's going to watch to see who raises their hand first. If you get the question right, then you get to pick a gift card, a $25 gift card out of our little treasure box over here. So we have this whole theme, obviously. Everybody has to wear their glasses. So you've all got some glasses in front of you because you're going to need those. They make you look smarter, if nothing else, right? And then you've got some Smarties that you can have for a little snack if you need a little. Yeah.
Smarties.
Okay, all right, so here we go. So these are all things that, just little nichey things, that you might not know, about financing that, like I said before, maybe I'll read a question that you'll be like, oh my gosh, that would work for this client. Or maybe in the future, if you've got a deal that's going sideways, you know, maybe something that you learned today will help you to save that deal. So, okay, so question number 1. You have a buyer who wants to purchase a townhouse in St. George that allows for short-term rentals. They're hoping to purchase it and rent it out, but to use it a couple of times throughout the year for themselves. What would the property be classified as? Primary residence, an investment property, or a second home? That is not correct. Okay, and why do you think it's a second home?
Because they will be staying there at some point.
Okay, and so what made you guess that it would be an investment property?
Because they want to rent it out.
Okay, so most people would say investment, because if you're renting it out at any time frame, right, and we're using rental income to help offset that payment, most people just assume it's got to be an investment property if I'm generating rent. The conventional guideline actually states that it has to be occupied by the borrower any portion of the year. So it can't be on a long-term lease. It could be family staying there where they could potentially come for a weekend during the year, or short-term rental. It could even be we rent it out for 6 months, you know, during winter, during summer. But the other portion of the year, we go down a couple of weekends. So what's the advantage of second home versus investment? Anyone know?
Better interest rate.
So the interest rate, it used to be much better for a second home. It's slightly better. But there's a bigger benefit.
Is it less down payment?
Correct. Right.
Boom, that's down payment.
Yes. So second home's 10% down, right? On a conventional loan, the minimum down payment on an investment property is 15%. So that's the advantage there. Did you give him? Okay, yeah, you can just walk over and have him. You get a prize, Anthony.
Which one would you like?
You can actually look at it.
Yeah. I get one that you actually.
You're gonna get.
He gets one.
I
didn't see the before in there. To get a pair of eyelashes.
Yeah, exactly. Eyelash extension. Okay, so this next one is, it didn't, last year had I read this question, it may not have applied much. Because again, we weren't getting seller concessions last year, right? But what type of financing would allow a seller to pay off debt on behalf of the buyer to qualify for their loan? So a seller could pay off a credit card, could pay off an auto loan for your buyer on this specific kind of loan. So it could be conventional, FHA, VA, USDA. Any guesses?
Conventional.
Nope. So conventional, the only thing a seller can contribute to is just closing costs, right? Closing costs and prepaids. No down payment, no debt.
USDA.
Nope.
VA.
Yes, so a VA loan will allow a seller to pay off debt for a buyer. So I just did a deal. I closed last week. And the property that the buyer really wanted was above their price point. But if they paid off their car, which was $13,000, their payment was $674, they qualified for the loan. So the buyer's agent asked for a concession for a buy down, for them to pay the closing costs and for them to pay off their $14,000 car. And they qualified for the loan.
So is it they just asked that much in concession
Mhm.
essentially?
Right.
That's cool.
Yeah, so again, only on VA, so it's very specific, but a great thing if you do loans for veterans and obviously, you know, a really great benefit for them, which is well deserved, right? So, okay. Question number 3. So Ian receives a call from Julie Jones, who is a past client. He helped Julie and her husband purchase their first home 5 years ago. Julie tells Ian that unfortunately her and her husband have recently divorced and she needs his assistance to buy another home. Per the divorce decree, her husband was awarded the home and is responsible for making any payments. However, Julie's name is still on the loan and it reports to her credit report. If I am pre-qualifying Julie for her house that Ian's going to look for, what portion of the payment of that previous home do I have to include in her debt to income ratio? What was that?
Yeah.
No,
All of it.
no.
Did she say something back here?
Wendy?
Did someone say something back here?
Oh,
okay.
20 per month.
nope.
None of it.
Yes. So that is correct. So if the divorce decree states that the other spouse is 100% liable for the debt, even if it reports on the credit report and the spouse hasn't, you know, maybe the divorce decree states that the spouse has to refinance the house at some point or has to sell the house at some point. Sometimes that can't happen, right? Sometimes the other spouse can't refinance. And so the spouse, the other person who vacated the home feels like, well, now I'm stuck. I can't buy a house until my husband or my wife is able to refinance. I'm going to be stuck renting. Now, it does affect their credit in a sense of if the spouse stops paying, I can't just say, oh, okay, we'll just ignore those liens. Unfortunately, because it hits their score, right? And it would affect the automated underwriting. But if the spouse is paying the bills and we're just talking about a debt to income ratio situation, I can exclude that entirely. So that's a situation where maybe a buyer called you and said that, and if you didn't know that, maybe you would be like, well, you got, you know, let me know when he refinances and then we can go find you a house. Right?
Yeah. But that would be part of the divorce paperwork as well, right?
Yes, it would have to state it in the divorce decree. Or even, I mean, there are other
So if
things
you're
like a
getting
legal
divorced,
separation.
Get that thrown in there.
Yes, I mean, usually that would be something that would be specified if someone's legally obligated, but that also, it just has to be a court order. So it could be a legal separation agreement or a bifurcation is another thing that.
Is that just an intercap thing, or is you have other lenders you work with, or what happens?
I mean, that's just a conforming conventional guideline.
I have somebody that fits that
I've got a
minus fluctuating.
How to get a divorce. Someone asked me that the other day, I'm like, easy peasy. Got that one down. Okay, you have a conventional buyer who is under contract to purchase the new home. He's planning to do a simultaneous close with the sale of the existing home. He didn't necessarily need the proceeds from the sale of the house, but when I did the application, he couldn't qualify with both payments. He wrote up the offer simultaneous with a simultaneous close contingent upon the sale. The buyers that are purchasing his home have exceeded all of their deadlines and are clear to close. So everything seems on track. We think we're closing on Monday, both transactions closing the same day. You get a call from the other agent and say, ooh, there's a small delay with the financing. We're going to need a 1 week extension. Can you still close on your transaction? So they have not closed on their sale. It's not recorded. Can you still close on your purchase?
No, because they don't qualify to purchase based on what you
With
said.
the payments?
With the payments.
Incorrect.
Yes.
Online, then,
How'd you figure that out? So the answer is yes. And the reason the answer is yes is if you have passed all contingencies. So you'll notice I said they're past financing and appraisal. So if they passed all contingencies on the contract and they don't need the money from the sale, I can exclude it from their debt to income ratio, even though it hasn't closed or recorded. And that isn't even necessarily on a delay. That's just, I mean, that could be upfront, like we know these deals, you know, sometimes you can't make a match up perfect, right? Like they're gonna be out of town, we can't close for a week past, but our deadline is this date. You can write up your contract so the F&A and deadline and the due diligence fit, so that you know we've exceeded that, we can close even though you haven't closed on the actual settlement.
So what if it actually doesn't close? You've already closed.
Yeah,
They're still.
I mean, yeah,
Obviously.
right.
Close, okay.
I
Interesting.
mean, it's interesting because it's a risk, right? But that's a standard conventional guideline. So a lot of times you get that call and maybe your transaction can't be extended. So that's just something to kind of keep in the back of your mind of, let's look at what the deadlines are on that other transaction. Can we still close on time? So. Okay, let's see.
we should ask the 5-year-old to answer these questions. She's in the corner.
I know, right? I'd be like, yep, got it. Okay, your client reaches out and explains that they need your help finding a home for his mom and dad who are moving from California to be closer to him. He wants to find them a property as close to his home as possible. He will be solely financing the home for his parents. They are on a fixed income and unable to qualify. So your client owns a house, the house 2 doors down goes up for sale. Mom and dad live in California. They're getting old. I would love to move mom and dad here, live a couple doors down. I can help take care of them. I'm going to buy that house 2 doors down. My parents are going to live there. My parents are not on the loan. They're on Social Security. They can't qualify for the loan. I'm going to buy it. They're going to live there. Is that a second home, a primary residence, or an investment property?
Oh, here, back here.
Okay,
Investment.
Whitney? Incorrect.
Secondary, his family's living in it.
Incorrect.
Oh, I'm trying.
Anybody? This is an easy one, James. Only one left. Yes, James. Yes.
There's only one option left.
I'm really good, but there's one option. So there is a guideline in conventional occupancy guidelines that if a child buys a property for a parent, not vice versa, if a child buys a property for their parent, it's considered a primary residence. So I personally bought a house this way. You put 5% down, just like you do on a primary residence, you get primary residence interest rates. And the parents are not involved at all. They're not on the loan, they're not on title, you don't get, I literally wrote a letter of explanation saying I'm buying this house for my mom, she can't qualify, and signed it.
Does it work for grandparents?
No, just parents, yep.
Are there any, benefits or any story you had where you could buy for a grandparent? Are there benefits for that?
Not that I'm aware of. No, it's kind of a weird little nichey thing that's,
No.
even when I've done that loan, I actually did a really cool scenario. He was a police officer here in Utah, and his mom lived in Arizona, he moved here. And he needed to get his mom here, but couldn't afford to buy a house for her, and she didn't have a job, she was on fixed income. So he bought a duplex as a primary residence. And got the rent from the other side, put 10% down, because it was a primary residence. Mom lived in one side, he rented out the other side of the duplex and paid for his mom to be here with him that way. So. About being creative. Let me see your wheels turn.
I have a question about that.
Yeah.
So, no, hopefully you can hear me.
I can.
So you can buy that for your parents, and it's considered a primary residence. So you already live in your primary residence. Say your parents decide to move out in 3 years, whatever circumstances. Can you resell that home as a lived-in primary residence and not have to pay capital gains tax?
That's a CPA question. Not my expertise. I don't know the answer to that.
Okay, thank you.
Yeah.
Hey, Missy, I have a question. Can you hear me?
Yeah, I can.
I'm not sure. I'm in Florida. We have homestead laws here. Does that apply there to Utah?
No, we're not a homestead state, but I do lend in Florida also. So I
Okay,
am
so,
familiar with what you're saying.
okay, so with homestead laws here in Florida, if I'm purchasing a house for my parents, I have a primary, I have homestead here. Can I homestead that home as well? Or because I think we can only do one homestead. How
Yeah,
that work?
I believe so. I did do a similar scenario there, and I think that's what they ended up figuring out. Again, not my expertise, because that's more of
Gotcha.
a question, but I do think that you can only have one homestead. So from a tax standpoint, maybe not, but from a lending and interest rate standpoint, that's where you'll get your advantage.
Got it. Got it.
Any other questions so far? Okay. Okay, you have an FHA buyer who purchases a home and puts 10% down. When can they expect their monthly mortgage insurance to automatically eliminate? I'm going to give you a multiple choice, make it a little easier. Okay, A, at 78% loan to value after 5 years. B, 78% loan to value anytime. C, 78% loan to value after 11 years. Or D, the mortgage insurance cannot be eliminated. It is for life of the loan.
D?
Incorrect.
Oh, damn.
Yeah,
That Sandra,
Sandra says never.
Cassandra, also incorrect. You're the B. So 78% with no time restraints. Incorrect. That is conventional.
See,
Remind me what we're talking about.
So FHA.
Oh,
So it is C, correct. So Anthony got it correct. So a lot of people think back in June of 2010, FHA changed the guideline that mortgage insurance could not be eliminated, right? So a lot of buyers say, oh, I don't want to do an FHA loan. They'll call me and I'll say, you know, they've got down payment, but for whatever reason, sometimes FHA is just better. Sometimes the interest rate is better. Sometimes the mortgage insurance is less. But most people believe that mortgage insurance on an FHA loan under no circumstances can ever come off. But 10% or more down, it can be eliminated after 11 years. So again, that's a long time, but still something that most people don't know. Okay, let's see, what time do we got here? Okay. All right, let me do. Okay, what is the minimum down payment requirement on an investment property?
Oh, you said it.
So not necessarily conventional. So I mentioned what a conventional down payment would be, but what's the very lowest you could get for a down payment on an investment property?
100%.
It
Incorrect.
says 20,
How much?
15.
So that's the conventional guideline.
20 or 10% by Kitty.
No.
Kitty is correct, but Kitty, you can't have a prize. I'm sorry, I'll send you a Starbucks. But yes, that's correct, 10. So we have a program that is 10% down, no mortgage insurance on an investment property, which is pretty dang cool. The conventional guideline would be 15% down and you would have mortgage insurance on a standard conventional, but we have a program that we offer
What are
10%.
the details, rough outline details on that?
680 credit score. I mean, really, it follows the conventional guidelines pretty closely. It's just there are some overlays that allow for less down payment and then no mortgage insurance.
Purchase price, limit, cap.
Is the jumbo, the standard conforming, which they just raised yesterday, maybe raised her to 726,400. So that will be awesome. Because it's tough to, I mean, they raised it to 647 or 624 last year, you know, before then it was so low that it was like every loan was jumbo, but it'll be nice to have it above that 700 mark. So next year. Okay, so this is a really cool one. You have a buyer who calls and is interested in making an offer on an $800,000 listing that you sent him. However, he has some concerns about qualifying for his financing. He mentions that he has trust funds sufficient to submit a cash offer. However, due to current market conditions, he doesn't want to pull any more than 20% out of his trust account. He's concerned that he will not be able to qualify for conventional financing because he's only been self-employed for 2 months and was unemployed prior to that. Is it possible for that buyer to qualify for conventional financing?
I'm gonna say yes.
Because you wouldn't tell the question if it was no, right? It is yes. So this is a really cool thing that most lenders are unaware of. And it works for lots of things. The self-employment part is just an example that I gave you because most people know that what's the standard guideline for being self-employed? Anyone know?
2 years.
2 years, right? So if you're doing a standard conventional loan, typically it's 2 years. We can get an exception at 1 year, full 12 months on a tax return if they were in the same line of work prior to becoming self-employed. But this particular program is if someone has, so your client that has lots of money in the bank, but has no job or a job that we can't use. So, and there are a lot of people out there that have money, but just don't have a way to verify their income. Maybe they're self-employed and they write everything off or they take a loss. This works for someone. I did this loan for an agent of mine who actually moved to Florida. So I couldn't use her income because even though she had been an agent here and she got her real estate license in Florida, it's a different market, right? An underwriter is going to look at that and say, well, so what that she sold those numbers here in Utah. That doesn't mean she's going to sell the same in Florida, right? Somebody that is paid maybe under the table. I had another client that was under contract and her husband, who was the primary wage earner, lost his job right in the middle of the contract, lost his job, but they have a ton of money in the bank. And so she just was like, we can't qualify. Like, I have this little job and we're buying, and the house was like 1.2 million. She could have never qualified for that loan. But this guideline, and again, it's a regular conventional loan, so it's not a higher interest rate, it's not more money down, it's a regular conventional loan. And the key is that in their trust, that they have to be able to access the funds without penalty. So I've got a Fidelity account that has $1 million in it that, you know, my dad passed away, and it's sitting there. I don't want to use it. I don't want to pay cash for this property. So I take the monthly payment. So I did an example of, you have a $640,000 loan based on the $800,000 house with 20% down. So with taxes and insurance, the payment's like $46.50. Let's say they've got $1,000 in car payments or credit cards. So total debt $56.50. So I would calculate, what does my debt to income ratio need to be? Typically I would go 45. That's pretty conservative. So I would figure out what would they need to make for my ratios to be 45, which is 12,600. So I would indicate 12,600 in their income under their trust income. They have to have sufficient money in that account for 3 years. So 36 months at 12,600. So $453,600 they would have to have in their trust account. If they do, I literally have a Word document that's a trust addendum that says, I'm the trustee of my trust, and I'm going to take out $12,600 every month. And I don't really have to even do it. I just have to have the ability to do it, right? So I need, from a lending standpoint, I need to know that you're willing to do that and that you're able to do that for a minimum of 3 years based on your current balance. So, like I said, that works with lots of different scenarios. Because I've had lots of clients in the past before I knew about this guideline, where they've just got a ton of money in the bank, but maybe they're retired and they, out of their IRA, just take enough to make their mortgage payment or to pay their bills. So I look at a tax return, their debt ratio is 100% because they don't want to pull out double what they need every month. They want to leave it in there and be collecting interest, right? So like I said, there's lots of different scenarios. So, and if the client that I mentioned, the agent that moved to Florida, she had money in her bank account, but her bank account wasn't in her trust. She called America First and said, I need you to move my checking account and invest it in my trust. We got a letter stating that checking account 123 invested in the trust, and it had, you know, in this case, $450,000 at this example, and we did the loan. She had no job. So that's a really cool one. Any questions? Any questions on my Zoom friends?
So you found out how to be in a trust.
The money has to be in a trust.
So could you set up a trust later? Like right now, if I found out about this program, I can do that and then there's no time frame.
Yeah, there's no time frame. So you just have to have the trust created and the asset has to be vested in the end of the trust. Any questions about that? Any questions about anything else as far as?
I learned a lot that I didn't know, so thank you.
Yeah. Good.
What other locations, what other states do you lend on, since we do have teams in several states? Florida, obviously.
Chanel helped me. This would have been helpful for her to be. So Florida, Oregon, Washington, Idaho, Colorado, Michigan, California, Nevada, New Jersey.
Wow.
And it's really easy. So I took way back in the day, back in 2006 or something, there was a test that I took that if for me to get licensed in a state takes me about 5 minutes.
Wow.
So it's just a national test that works for all states. So I just have to go on and register real quick, assuming Intercap is licensed there. which we're licensed in, I think, 47 states. So if there's someone that has a loan, so if you have clients that are moving, it's really nice to be able to, or they're trying to buy an investment property. I do lots of loans in, Indiana is another one, Illinois. I have agents here that live here that buy investment properties in other states. So I just get licensed, so they can still work with me. I can still do their loan.
Like Texas, that's a great.
Yeah, I'm
investment state
licensed in
right now.
Texas. So it's nice to be able to, if you do have a client or you personally, and they're moving or they want to buy somewhere else, right? If you don't know a lender there, you're just like, oh, well, good luck, right? So it's nice to be able to say, hey, the lender I use here in Utah, she's licensed in that state. Call her, she'll totally help you. So, that's really nice.
Do you have any spec loan products,
Like a,
spec homes? So non-owner occupied, new build, construction,
we do construction loans, yes, and we can't actually do a spec construction loan. I broker it out.
2.2 million.
I would have to call,
That's a nice spec.
but yeah, you'll have to get my card and call me and I'll have to call on that. Those are kind of like case by case, right? I would need to call them. Yeah.
Any questions on the out-of-staters or people on Zoom? Do you guys have any questions that she
Yeah.
maybe didn't cover?
Hey, yeah, Missy, I'm definitely gonna put you on speed dial because I mean, I promise you, you 10% on an investment, you just do not find anywhere here. I mean, I must have
Right.
gotten I must have called so many lenders and connected with so many, nobody will give less than 15. I mean, when you said 10%, I'm like, oh my God, you're on my speed dial. Oh my God.
Yeah, I love that. I would love that.
Yeah, because the majority of the lenders here all either 20% and then maybe one or here will do maybe 15, but never
Right.
10. So that's
Yeah, it's
awesome.
a really, really great program. And like I said, the no mortgage insurance is awesome too.
Oh, that's a
Mortgage
great.
insurance, when you put 15% down, is pretty expensive on an investment.
I have a
Yeah.
question of the VA loan situation.
Uh-huh.
Is there a certain amount that the seller is able to pay off a debt? Like, what exactly?
So the.
That's a really good.
4%, 4%.
Of their debt.
So the question was, what amount of concessions can a seller give to pay off debt for a veteran? In that example that I gave, so up to 4%, plus they can still give an additional 3% in concessions towards closing costs or buy down. So I mean, that's a substantial amount, right? And like I said, in the market here, and every market's a little different, but sellers right now are willing to give concessions.
Mhm.
Come
Yeah,
back.
So,
that's
yeah.
good.
yeah.
It's a good one.
So again, I mean, my main reason, my philosophy is when I have agents that work with me, I don't expect you to know my job. You're good at what you do. And so I like my agents to feel comfortable just saying, call Missy, like she will totally take care of you. That's her lane. I need to stay in my lane. So I'm not telling you these guidelines because you should like memorize them and quote them to your clients. But my main purpose is it's important that you work with a lender that has been in the business, has knowledge, because there's just these little tricks and things that if the loan officer doesn't know that, you have to be able to think out of the box in this business, right? And if this doesn't work, or if this comes up, because it's something always comes up, it doesn't matter what, there's just a lot, everybody's scenario is so different. And so you just need to make sure that you're aligned with, a loan officer like me, that is knowledgeable. And when something does happen, or when you have a tricky situation, that I'm like, oh, I have an idea. Like, there's this guideline that I know, or there's this situation, or let's put less down and let's pay this off instead. And like I said, you just have to think outside of the box to make things work in a creative, ethical way.
Ethical.
Yes.
Do you want to introduce your team? Did we?
I did.
Okay, I didn't, I was downstairs, so I apologize. Are there any other questions online that we can answer? Because we are just gonna get ready to wrap this up. There's so many key points, takeaways from this particular meeting that I had no idea creative financing like this could exist. So I'm taking away from this meeting what you always say is there is so much opportunity right now where everybody is feeling a little bit negative about the market. If you're working with buyers, there is tons of opportunity as well as there is tons of opportunity still for listings, but you have to align yourself with the right type of people. So thank you, Missy. So awesome. There are so many great things. And you guys online, we wish you were here because she has put together some of the coolest lunch giveaways that I've ever seen. There are these amazing little lunch boxes. So thank you so much. It's been such a pleasure having you.
Thank you.
Yeah, and we'll get all of that information over to everyone online and then everybody here. So is there any other questions in the group? Before we close everything out? Yeah. Thank you. Appreciate it. Thanks you guys for joining. Good luck with your properties and closings. May you all have a wonderful money week. See you guys.
So there's a little old fashioned lunch box back here for you guys. So grab your lunch.